Let's jump right into this explainer. We hear a ton of hype about the upcoming public debuts of SpaceX, OpenAI, and Anthropic. But today, we're flipping the script. We're not going to look at these listings as massive media spectacles. Instead, we're going to look at them as a mechanical shockwave to the stocks you already own.
Think about what happens when $3 trillion hits the public markets all at once. Right now, SpaceX, OpenAI, and Anthropic represent literally the largest private-to-public capital transition in market history. Their combined expected valuations? Somewhere between $3 to nearly $4 trillion. We really need to understand how this massive wave of new equity is going to forcefully drain liquidity from existing public markets. It's a fascinating mechanism, and it's going to affect almost anyone holding an index fund.
To unpack exactly how this works, here's our roadmap. We'll cover the mega IPO wave, the hidden index plumbing, the arithmetic of selling, the 5x multiplier, and finally, the passive investor drag.
Starting with part 1, the mega IPO wave and its truly unprecedented scale.
The largest IPO ever completed was Saudi Aramco back in 2019, which raised a record $29.4 billion. But there's a massive difference here. Aramco was a state-owned enterprise listed locally, meaning it triggered exactly 0 U.S. index inclusion flows. SpaceX, on the other hand, is targeting a $50 to $75 billion raise. That completely dwarfs Aramco's record, and more importantly, it will be immediately injected right into the most heavily tracked U.S. passive benchmarks. And this really isn't a question of opinion, it is a question of pure arithmetic. Today, the broader passive fund universe, which covers all index mutual funds and ETFs in the U.S., has exploded to over $19 trillion. Because index funds now control the majority of U.S. equity assets, they are structurally forced to respond when these massive new companies enter the public sphere. It's inescapable math.
Let's move to part 2, the hidden index plumbing and these structural obligations.
Think about how your money is actually managed. An active manager can look at a hot IPO, decide the valuation is way too high, and just pass. They choose not to buy. But if you hold an S&P 500 ETF or a NASDAQ 100 fund, your manager makes zero strategic decisions. They act more like a blindfolded robot, structurally obligated to track their benchmark no matter what. And since index funds are fully invested, meaning they hold almost zero cash, the absolute only way they can buy newly added mega-cap stocks is to blindly sell their existing holdings.
So the crucial point is this 4-step mechanical process. When an index provider announces an addition, fund managers calculate the required weight based on the new company's float-adjusted market cap. Then, they literally have to sell a pro rata slice of every single existing holding to raise the cash, and finally, purchase the new shares at the close. What does this do? It triggers a brief, intense period of broad-based selling pressure across hundreds of existing index constituents, all just to fund the mandatory purchase of the new company.
Which brings us to part 3, the arithmetic of selling and calculating that drain.
We aren't just looking at massive IPOs here. We are looking at incredibly compressed inclusion windows. NASDAQ has a fast entry rule that allows mega-cap IPOs to be added in just 15 trading days. S&P, meanwhile, is reviewing a proposal to cut its seasoning period down to just 6 months. This means these massive forced rebalancing events could be jammed into incredibly short timeframes, potentially starting as early as June 2026 with SpaceX.
Let's put some numbers to that SpaceX event. If SpaceX enters the S&P 500 at a conservative $250 billion float-adjusted market cap, its index weight would be roughly 0.41%. Now, with $12 trillion tracking the S&P 500 alone, index funds will be structurally forced to execute $49 billion in non-discretionary selling of their existing holdings. $49 billion, just to fund that one single purchase.
And if we extrapolate that to a scenario where SpaceX, OpenAI, and Anthropic all enter the index within a tight 12-month window, we are looking at an astonishing $97 billion in total forced selling. That is almost $100 billion mechanically drained from existing companies like Apple, Microsoft, and NVIDIA, just to foot the bill for these new AI and aerospace giants.
Let's look at part 4, the 5x multiplier and inelastic markets.
Now, you might be thinking, hey, $97 billion sounds pretty manageable against a U.S. equity market that trades $1 trillion a day, right? Well, let me introduce you to the Inelastic Markets Hypothesis. Developed by researchers at Harvard and Chicago Booth, this hypothesis proves that modern equity markets are far less elastic than we typically assume. Their central finding is that an exogenous flow, meaning fresh external money, of just $1 into or out of the stock market alters aggregate market capitalization by approximately $5. Why is that? Because so much market capital is rigidly locked up in passive vehicles, there simply aren't enough active, contrarian buyers to absorb massive forced selling without significant price drops.
So when we apply that 5x multiplier to our 12-month mega IPO window, that $97 billion of raw, plumbing-driven outflow actually creates a staggering $485 billion in downward price pressure on existing public equities. It essentially acts as a massive, broad, and diffuse headwind across the entire market. Think about the daily trading volume for giants like Apple and Alphabet. On the exact day of an S&P 500 rebalance, the raw forced selling equals about 20% of their average daily volume. But when you apply that 5x amplification from the inelastic market, they face a one-sided sell imbalance equal to roughly 100% of their entire daily trading volume. This is non-discretionary, completely price-insensitive selling, hitting literally the biggest stocks in the world.
Finally, Part 5. The passive investor drag, and what this actually means for you.
Even if you don't pick individual stocks and just comfortably hold a standard index fund, you are still absolutely affected by this. Index fund investors suffer from what's known as index inclusion drag. Because your fund operates totally mechanically, it's forced to buy these hyped IPOs, like SpaceX and OpenAI, at the exact moment their price is inflated by early active traders. And simultaneously, it's dumping your existing profitable blue-chip stocks at a forced discount to pay for it. You are structurally forced to buy high and sell low.
And remember, these estimates of roughly $100 billion in forced selling, those are actually conservative bottom-line figures. They don't even include total market funds or global benchmarks. If large active managers join the frenzy to buy these must-own AI and aerospace giants, they'll be selling their other holdings too, meaning the drain on existing stock liquidity will be truly historic. The pipes of modern finance are going to be tested like a city's plumbing during a massive Category 5 storm.
Now, none of this is a reason to abandon long-term investing. Absolutely not. But it absolutely demands that we ask a critical question. When the invisible plumbing of the market goes into reverse to absorb $3 trillion giants, how protected is your wealth from the pure arithmetic of forced selling? Understanding these mechanics is your very first step to navigating the mega IPO wave ahead. Keep an eye on those inclusion dates because the math is coming.